Hi, everyone. Welcome to State of the Market. I'm Mark Lichtenfeld, Chief Income Strategist with the Oxford Club. And if you haven't subscribed yet, join the other 12,000 people that already have. It's absolutely free. So go ahead and click that subscribe button. All right. My daughter is taking her first economics class, and she asked me to help her study. And we were talking about core CPI, which tracks the costs of goods and services, excluding food and energy, because, no one really uses those things. So other than the occasional outfit, food and gas are about the only thing my daughter actually spends money on. So she thought that indicator was ridiculous, and I agree. Now, the current inflation rate, including food and energy, is 5.3%, higher than it's been in decades. The Fed says the high inflation is, quote, transitory. That's the word they used. They think it's temporary. And some of it may be. Pent-up demand from the pandemic is certainly adding to the frenzied buying, which is pushing up prices, and so are supply chain disruptions that still haven't recovered from the pandemic that are affecting nearly every industry. Now, some of that may let up now that extended unemployment benefits are running out, so folks will no longer get paid to sit and watch Maury to find out who the baby's daddy is.
You are not!
But the idea that inflation is transitory when the Fed is dumping trillions of dollars into the economy and keeps rates at rock bottom levels is laughable. Housing prices have gone berserk all over the country, from small towns in Idaho to white-hot South Florida. Considering you can get a mortgage for 3% and a jumbo mortgage for 3.2%, it is no surprise that people are paying up for their dream house in their dream locations. Now, the Fed's inflation target is 2%. And as I mentioned, it's currently over 5%. Now, I expect inflation to go even higher. Now, let's assume the Fed miraculously gets it right. I know, but stick with me here. So let's say inflation stays at 5% for just another year and then dips down to the Fed's target of 2% for the next 9 years. After 10 years, prices will still be 25% higher than they are today. A $40,000 car today will be $50,000. A $50 meal at a restaurant will be $62.50, and the estimated $300,000 that a 65-year-old married couple today is expected to spend on healthcare in their lifetime will cost $375,000. Now, of course, healthcare is not going up 2% a year. It's rising about 5.5% per year. Now, if that continues, in 2031, the $300,000 in healthcare costs that a 65-year-old couple will incur today rises to $512,431. So the government has two levers to help tame inflation, and neither of which they appear intent on using. They can stop printing trillions of dollars in stimulus for an economy that no longer needs it.
Oh, wait, you serious? Let me laugh even harder.
And it can also move interest rates higher. Now, higher rates would also help savers who are currently getting buried, earning 0.1% in their bank accounts while prices for everything they need is surging. So what can you do so that the government's mismanagement of inflation doesn't ruin your buying power? When I wrote my international bestseller, Get Rich with Dividends, it was for exactly this moment. In it, I recommended buying perpetual dividend raisers. These are companies that raise their dividends every year. And that way, you're increasing your buying power as you get paid more dividend income each year. For years, inflation was quite low, so those ever-increasing dividends were great and really boosted investors' buying power. But now that inflation is surging, it's more important than ever to have a growing income stream so that your buying power doesn't decline. No one wants to be able to afford less as they get older. So you need an investing strategy that will not simply hand you a big pile of money to draw down from. You want your pile of money to generate more money every year so that you don't have to withdraw from your nest egg until it dwindles down to dangerous levels. Investing in companies that raise their dividends every year is one of the very few weapons you have in your investing arsenal to make sure the government's mishandling of the economy doesn't affect your lifestyle. Now, I'm talking about companies like tiny Missouri regional bank Hawthorne Bank Shares. ticker symbol HWBK, that's raised its dividend an average of more than 14% per year over the past 10 years, including a 14% hike in the past year. Or the much larger Magna International, ticker symbol MGA, which makes technology for the auto industry and has boosted the dividend an average of 15% per year over the past decade. Now, if you'd bought 100 shares of Magna International 10 years ago, you'd have received $100 per year in dividend income. Today, you'd receive $354, and your yield on your original investment would be more than 21% per year. And not surprisingly, the company's earnings, cash flow, and dividend all grew. So did the stock price. It's up nearly 356% over the past 10 years. So performance like that will help you maintain and increase your buying power in this current or future inflationary environments. Now, I discussed inflation, taxes, and of course the government's role in the economy with former White House economic advisor Larry Kudlow recently, and he had some pretty provocative things to say. So click the link in the description below to hear our conversation. Thanks for watching State of the Market. I'm Mark Lichtenfeld. I will see you next time.